I am not being dramatic. The information I am about to share with you is the kind of information that trading institutions spend millions of dollars keeping obscure. Not because it is illegal, not because it is dangerous, because it is valuable. And valuable information, in the world of financial markets, has always belonged to the people who can afford to pay for it, until now. What you are about to read took me 11 years to understand completely. 11 years of trading professionally, studying institutional behavior, analyzing patterns across every major market in the world, and slowly, painfully slowly, piecing together the answer to the one question that every serious trader eventually asks. What time frame do the banks actually trade on? Not what they tell you, not what the textbooks say, not what the trading courses teach, what they actually do, every single day, with billions of dollars, in markets that move the moment they decide to move them. The answer is going to surprise you, and once you understand it, truly understand it, not just intellectually but structurally, you will never look at a chart the same way again. The lie you were sold from the beginning. Let me tell you about the lie first, because without understanding the lie, the truth will not land with the force it deserves. When you first started trading, when you opened your first charting platform and saw those moving rows of candles, someone told you something. Maybe it was a YouTube video, maybe it was a trading course, maybe it was a forum post from someone who sounded like they knew what they were talking about. They told you to find your time frame, and then they gave you a list. Scalp on the 1 minute, day trade on the 15-minute or 1 hour, swing trade on the 4-hour or daily. Pick your style, they said. Pick your personality. Pick your schedule. What they never told you, what nobody in the retail trading education world ever says out loud, is that this framework was designed for retail traders, not professional ones, not institutional ones. The banks are not sitting in front of 15-minute charts looking for head and shoulders, patterns. The hedge funds are not waiting for a 5-minute RSI divergence to tell them when to deploy capital. The entities that actually move markets, that create the trends you try to trade, the support levels you try to buy, the resistance levels you try to sell, they operate on an entirely different framework, and understanding that framework changes everything. What banks actually are, and why it matters, before revealing the time frame, you need to understand something fundamental about institutional participants that most retail traders have never grasped. Banks are not traders in the way you are a trader. You sit in front of a screen, looking for opportunities, making decisions in real time, reacting to market movement as it happens. Banks are more like infrastructure. They are the plumbing of the financial system. They facilitate enormous flows of capital for clients, for themselves, for the market-making function they perform. The decisions that drive their major positions are not made by someone watching a 1-minute chart. They are made in meetings, in research sessions, based on fundamental analysis, macroeconomic data, geopolitical developments, central bank policy, and long-term capital flow projections. These decisions play out over weeks, over months, sometimes over years. And here is the critical insight, the one that changes everything when you truly absorb it. The time frame that reflects these decisions is the daily chart. Not because it is the right time frame in some abstract sense, because it is the time frame that aligns with the tempo of institutional decision-making. 1 candle per day, each candle representing a full session of institutional activity, each closing price representing the net judgment of every major participant in that market about where value lies at the end of that day. The daily close is not just a price. It is a verdict, a collective, institutional verdict about what this asset is worth, reached by the combined analysis and capital of every significant player in the market. This is what you are reading when you read a daily chart, not random price movement, institutional verdicts, stacked one on top of another, day after day, week after week, forming the trends and levels that represent real market structure. The number that proves everything here is a fact that most retail traders have never encountered. The Bank for International Settlements, the central bank of central banks, publishes data on global foreign exchange market activity. According to the most recent comprehensive survey, average daily turnover in the global FX market exceeds $7 trillion. $7 trillion every single day. The vast majority of this flow is institutional. Banks, asset managers, hedge funds, central banks, corporations managing currency exposure. Now ask yourself this question. Does $7 trillion per day move in response to what is happening on a 1-minute chart? Or does it move in response to fundamental developments, economic data releases, central bank decisions, geopolitical events, long-term capital allocation decisions that unfold over days and weeks? The answer is obvious when you state it clearly. $7 trillion does not flow based on 5-minute RSI readings. It flows based on the macro decisions of the world's largest financial institutions, decisions that play out over the daily and weekly timeframes. The 1-minute chart is retail activity, noise, the digital equivalent of small fish splashing near the surface of the ocean. The daily chart is the whale, slow, deliberate, unstoppable, moving in a direction determined by forces so large they do not care what the 1-minute chart is doing. Trade with the whale, or get crushed by its wake. How institutions actually use the daily chart. Now we get to the mechanics, the part that will immediately change how you analyze every chart you ever open. Institutional participants use the daily chart in 3 specific ways. Understanding all 3 is what allows you to see the market the way they see it. The first way, trend direction. Every institutional trading desk begins its analysis with one question. What is the dominant trend on the daily chart? Not the hourly trend, not the 4-hour trend, the daily trend. Is price making higher highs and higher lows on the daily chart? That is an uptrend. Institutional bias is long. New positions will be added on pullbacks. Resistance to trend will be temporary. Is price making lower highs and lower lows on the daily chart? That is a downtrend. Institutional bias is short. Rallies are selling opportunities. Support levels will eventually fail. The daily trend is the directional mandate. Every trade at every time frame that conflicts with the daily trend is fighting against the weight of institutional money. And institutional money does not lose fights. This is why retail traders on lower time frames get destroyed by moves that seem random and sudden. They are not random. They are institutional positions being executed in alignment with the daily trend. Positions so large that they move price regardless of what the lower time frame structure says. The second way, key structural levels. On the daily chart, every swing high and swing low represents a price level where institutional activity was concentrated. A swing high on the daily chart is a price where sellers overwhelmed buyers over an entire trading day or multiple days. That level represents a genuine area of institutional supply. A swing low on the daily chart is a price where buyers overwhelm sellers, a genuine area of institutional demand. These levels do not exist on a 1-minute chart. They cannot. A 1-minute swing high is a price where 1 second of selling exceeded 1 second of buying. It has no structural significance whatsoever. A daily swing high, where the collective judgment of every institutional participant across an entire trading session concluded that price was too high, is a level that will be remembered. It will be tested again. It will act as resistance when price returns, because the same institutions that created that level are still in the market, still managing positions, and their institutional memory of that level remains active. This is why certain price levels appear to stop price dead, even on charts that seem to have no obvious technical reason for the resistance. The reason is on the daily chart. It is always on the daily chart. The third way, the institutional entry. When banks and large institutions decide to build a position, when the fundamental thesis is clear and the time to deploy capital has arrived, they do not buy all at once. They cannot. Positions measured in billions of dollars cannot be entered in a single transaction without moving price against themselves. So they accumulate, gradually, methodically, over multiple days, using the natural volatility of the market to fill their position at a range of prices rather than a single one. This accumulation process leaves specific fingerprints on the daily chart. Price clusters at a key level. It moves up and down within a tight range for several days. Then, when the accumulation is complete, it launches. A strong, decisive daily candle breaks out of the range in the direction of the institutional position. This breakout candle is the institutional entry complete. The position is built. Now it is time to let the position run. The retail trader, who knows how to read this sequence on the daily chart, is not chasing price. They are entering alongside the institution as the accumulation completes and the directional move begins. This is what it means to trade with the banks, not to follow them blindly, to read the evidence of their activity on the daily chart, and to position yourself in alignment with what they are doing. The pattern you are now going to see everywhere here is the practical synthesis, the pattern that emerges from understanding institutional daily chart behavior. Once you see it, you will find it on every chart you open. Phase 1. The trend is established. The daily chart shows a clear directional trend, higher highs and higher lows. The institutional bias is known. You know which direction to trade. Phase 2. The institutional pullback. After every strong directional move on the daily chart, price pulls back. This is the bank accumulating at better prices. The pullback looks frightening to retail traders. Many of them exit their positions, convinced the trend is reversing. It is not reversing. It is creating opportunity. Phase 3. The daily level holds. The pullback reaches a significant daily structural level, a previous swing high that has become support, a major moving average, a Fibonacci retracement of the most recent impulse. Price hesitates at this level. A daily rejection candle forms, a hammer, a bullish engulfing, a pin bar with a long lower wick. The candle closes strong, near its high, showing that buyers overwhelmed sellers by the end of the trading day. This daily candle is the institutional verdict. This level holds. The trend is resuming. Phase 4. The entry. The close of the daily rejection candle is your entry signal. Enter in the direction of the trend. Stop loss below the candle's low, below the level that the institutions just defended. Target. The previous swing high in an uptrend. This is the trade. This is how the bank's daily chart activity creates the highest probability setups available to any retail trader. Not complex, not multi-indicator, not requiring hours of analysis. One chart, one time frame, one candle per day, and the ability to read what that candle is actually saying. Why you have been on the wrong time frame, and what it has cost you. Let me be direct about what trading on lower time frames has actually cost you. Every hour you spent on a 15-minute chart, watching noise, taking false signals, getting stopped out by random fluctuations, was an hour you could have spent understanding what the daily chart was telling you. Every loss you took because a support level on your 5-minute chart failed, that level failed because it had no institutional backing. It was a retail level. Retail levels fail. Institutional levels hold. Every time you were stopped out at what seemed like the perfect low before price reversed, that stop hunt happened because retail traders cluster their stops at visible short-term levels. Institutional players know this. They push price through those levels to collect the liquidity, and then they reverse in the direction they were always going to go. None of this happens to the daily chart trader. The daily chart trader is not in the trade during the intraday noise. Their stop is below a genuine institutional level, a level so significant that moving price through it would cost the institution more than it is worth. Their target is a real structural level, the next area of institutional supply or demand on the daily chart. They take fewer trades. They hold positions for days rather than minutes, and they make more money because every trade they take is aligned with the forces that actually move markets. The complete daily chart system, start here, tomorrow here, is exactly how to begin trading the bank time frame, starting with your very next session. Tonight, analysis. Open every instrument on your watch list on the daily chart. Identify the trend, higher highs and higher lows, or lower highs and lower lows. Mark the key structural levels, the significant swing highs and lows of the last 3 to 6 months. Identify any instrument where price is approaching a key level. Tomorrow morning, setup check. Check which instruments have price at or near the key levels you identified. Has a daily rejection candle formed? Is the candle strong, closing near its high for support levels, or near its low for resistance levels? Entry on the candle close. If a rejection candle has formed at a key level in the direction of the daily trend, enter on the close of that candle. Set your stop below the candle's low. Set your target at the next significant structural level in the trend direction. Management, once per day. Check your positions once per day when the daily candle closes. Has the structural picture changed? Is price still behaving consistently with the trend? If yes, hold. If the daily structure has been genuinely broken, reassess. That is the complete system. No indicators needed. No hours of screen time required. No intraday stress. One analysis session. One daily candle. One decision. The bank time frame. Conclusion. The time frame was never the mystery. The banks did not keep their time frame secret. It was never hidden. It was never classified. It was always right there, available on every platform, visible on every charting system, free for every trader in the world to open and read. The daily chart. The mystery was never the time frame. The mystery was understanding what the daily chart actually represents, and why reading it correctly means reading the market, the way the people who move markets actually read it. You now have that understanding. The daily chart is not a slow version of the 1-minute chart. It is a completely different language. The language of institutional position building, of macro decision making, of capital flows measured in billions, aligning around specific price levels. Learn this language. Truly learn it, not just intellectually but practically, through daily observation and patient application. And you will never need another indicator, another signal service, or another trading course. The chart will tell you everything. It always has. You just needed to know how to listen. Drop a comment. What time frame have you been trading on? And after reading this, are you going to make the switch? Tell me exactly what you are going to change. The big money is made by sitting, not by trading. Jesse Livermore.